I have seen firsthand how critical it is for organizations to maintain transparency and accountability in their financial dealings. A key component that supports these principles is the audit trail. An audit trail provides a detailed and systematic record of financial transactions, allowing businesses to trace their activities, verify information, and ensure that all actions can be accounted for. In this article, I will delve into the concept of an audit trail, its significance, and how it can be a vital tool in protecting businesses against scams and fraud, particularly in the context of resources available in the United States. What is an audit trail? An audit trail is essentially a comprehensive record that tracks the chronological sequence of financial transactions related to an organization. It includes vital details such as transaction dates, amounts, parties involved, and any modifications made to financial records. The primary objective of an audit trail is to provide a clear, verifiable path of information that can be referenced for future analysis and verification. Key components of an audit trail. 1. Source documents. These foundational elements include invoices, receipts, contracts, and any relevant paperwork that supports financial transactions. For example, the IRS mandates that businesses retain source documents for at least 3 years, as these documents provide essential proof during audits or investigations. 2. Transaction records. Each entry in an organization's accounting system should reflect comprehensive details of financial activities. This includes the date, time, amount, and parties involved in each transaction. For instance, businesses in the U.S. are required by the Sarbanes-Oxley Act to maintain accurate financial records to prevent fraudulent activities. 3. Change logs. Documenting any amendments to transaction records is crucial. This includes noting who made the changes and the reasons behind them. This not only ensures accountability but also aids in identifying any discrepancies that could indicate fraud. Why are audit trails important? Ensuring transparency. One of the most significant benefits of an audit trail is the transparency it offers. By maintaining detailed records of every transaction, businesses can provide stakeholders, investors, regulatory authorities, and customers with access to verifiable financial information. This level of transparency is vital for building trust. According to a survey conducted by the Association of Certified Fraud Examiners, ACFE, organizations with effective fraud detection and prevention measures, including robust audit trails, report significantly lower fraud rates. Enhancing accountability. Having an effective audit trail in place allows organizations to hold individuals accountable for their financial activities. When employees know their actions can be traced back to them, it deters fraudulent behavior. For example, the infamous case of Enron showcased how a lack of transparency and accountability in financial reporting can lead to catastrophic consequences. Had Enron maintained stronger audit trails, it might have mitigated the fraudulent practices that led to its downfall. Facilitating compliance. Many regulatory frameworks in the U.S. require businesses to maintain accurate financial records, making audit trails essential for compliance. Regulatory bodies like the Securities and Exchange Commission, SEC, enforce strict regulations concerning record-keeping. A comprehensive audit trail can help demonstrate compliance, thereby reducing the risk of penalties and legal issues. For instance, companies like Wells Fargo faced significant fines due to inadequate oversight and failure to maintain proper audit trails, highlighting the need for meticulous record-keeping. Supporting decision-making. Accurate and detailed audit trails provide invaluable insights into an organization's financial health. By analyzing these records, management can make informed decisions regarding budgeting, investments, and resource allocation. For example, businesses can use historical transaction data to identify spending patterns and adjust their financial strategies accordingly. This data-driven approach not only enhances strategic planning but also fosters organizational growth. Real-world example. Recent financial scandals have highlighted the importance of robust audit trails. Take the case of Wirecard AG, for instance. The company's downfall was partly attributed to a lack of transparency and ineffective auditing processes. With missing audit trails, it became impossible to trace financial transactions, leading to a massive fraud scandal that resulted in billions of dollars in losses. In contrast, companies like Microsoft have implemented strong internal controls and audit trails, which have allowed them to maintain high levels of accountability and transparency, thus avoiding similar pitfalls. In conclusion, I firmly believe that audit trails are an indispensable component of effective financial management. They enhance transparency and accountability, facilitate compliance, and support informed decision-making. By prioritizing the implementation of robust audit trails, businesses can protect themselves from the risks associated with scams and fraud. As I often remind my clients and colleagues, a commitment to maintaining strong audit trails not only fosters a culture of integrity but also contributes to long-term success. For those seeking further insights on the importance of audit trails and how they can safeguard your business, I recommend exploring reputable sources such as the Financial Times and the International Federation of Accountants, IFAC.